Branden DuCharme is an investment advisor representative and offers investment advisory services through SCF Investment Advisors, Inc., an SEC-registered investment advisor, 10150 Melanie Drive, First Floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors, Inc. and DuCharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources of data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific, individualized tax or legal advice. DuCharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speaker in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with DuCharme Wealth Management unless otherwise indicated. All right, hey guys, today in the studio we have a friend of mine, Aaron Best. He is the owner of Best Wealth Management. He has his own investment advisory firm, so not part of my firm or my team, but a friend of mine and another independent investment advisor. Aaron carries a Certified Financial Planner designation, CFP. Been in the industry for going on
about 10 years.
10 years.
Yeah.
10 years. So has a great reputation in town personally. And just all around nice guy to be around. I've enjoyed conversations with Aaron in the past, talking about some different techniques, ideas, financial planning strategies. And so I thought, what a great idea to have him on the podcast, and we could jam together and hopefully bring some of that value so that you guys can listen on what those conversations are and, hopefully pick up a little bit of education and nuggets. And he's a great guy that has some knowledge and resources and thinks differently than I do on some things. And, where we do align on, for certain, is that we are looking to help people in a meaningful way and do the right thing by our clients. So that always leads to some really great discussions. So Thanks for joining us, Aaron. What did I miss? Family, kids, where are you from?
So thank you for having me on here. So I grew up in southern Utah. So I am actually from Laverican. That's why I kind of brought it up with that clock over there.
Okay.
They're a little bit slower. Sure, I was probably a little bit slower. But I grew up in Laverican. I did all the things that, you're supposed to do. I went to Hurricane, went on a mission in Wisconsin, which apparently, we might have met once or twice, or I don't think we ever actually met. I think I met your sister. I don't know if you remember.
I think I maybe remember running into you a couple times, but I'm going to touch on that after. Go ahead.
Okay. So I went to Wisconsin for 2 years, served a church mission. When I got back, I was very much interested in going into the medical field. Had a good conversation with my mission president at the time and kind of decided to go that route. Had a scholarship to go to Utah Valley University. I wasn't necessarily smart per se. I was a hard worker, but I could throw a big heavy ball really far. So I threw shot put, discus, and hammer at UVU, got a scholarship there. But during that time, I took a personal finance class where they were opening up a program to be a CFP, Certified Financial Planner. Mm-hmm. So when I was taking that class, it just seemed awesome how money could really work for you, and it can also work against you. Mm-hmm. And so that kind of changed my direction of where I wanted to go. So I graduated from UVU in their financial planning program, got married during that time, had a kid or two. Well, how many kids do I have?
A kid or two.
I've got 4 kids. The oldest is 9, and the youngest is 1. I finally got my girl at the end, which is great. But I joined a company called Vantage Advisors down in St. George, just down here in the same building. I started with them. This was back in 2015. What was really cool about them is they were CPAs that got into financial planning. And so everything they did was very tax savvy, tax centric. And so that's how I would say the majority of the clients that we got usually had a tax problem, and then then we kind of developed and was kind of introduced to do all their other financial planning stuff, investments, taxes, insurance, that type of thing. And so when I was with them for probably about 8-9 years, they recently went through a merger with EP Wealth. EP Wealth is a big RIA out of California. And I eventually just kind of broke off and did my own thing. It just wasn't a good situation for me. I have really good, really good feelings leaving. I mean, they really helped me break off to do my own thing. They're kind of really focusing on the bigger clientele. I like working with people that are not that kind of threshold.
Sure.
And so, this is only about 2 months ago that I went off and did my own thing in the same building as you.
Yeah, that's an interesting coincidence that we kind of reconnected that way when, my firm moved into this office earlier this year, and you reminded me when we were kind of reconnecting and made that Wisconsin connection about the famous Lambeau Leap.
Yeah. Okay.
So, for anyone that knows Aaron, next time you talk to him, make sure to ask him about the Lambeau Leap back in Wisconsin.
As a missionary, sometimes you do dumb things.
But
then you get better.
We'll leave it at that. We'll leave it at that. It's a classic, but we'll let you tell the story in your own time there. Anyway, so one of the things that you just talked about that I found really interesting is the tax savvy portion of financial planning, right? So that's kind of how I grew up in the business, so to speak, right? My dad was a CPA before he founded the firm. I mean, he still is a CPA, right? Still carries a license, but he worked for one of the big fours in public accounting and had a CFO background in private industry and stuff before he started our firm. And so he's kind of oftentimes had a very tax-centric, tax-efficient planning process, about the methodologies and stuff.
Which is awesome, because I would say a lot of advisors went from like that sales background. But that sales background means you're just looking, you might not be in the best interest of someone in compared to being a CPA. Yeah, you have that higher standard. Yeah,
one of the things that's interesting is I've noticed over the last several years is that CPAs or just accountants in general come off to people because it's such a clear engagement, right? Like, hey, I pay you to do my taxes, and your job is to save me the most amount of money on my taxes. And I typically see that in the form of the biggest return. Like most people see it that way.
Sure.
Or
right.
So, the reduction in the tax bill, right? Like, hey, you were going to owe this much and you worked with me and I got it down to this much. So, I saved you X dollar amount, right? And they pay you a flat dollar amount to file the return, or they're paying you hourly or whatever. Yeah. And I think because of that, people see this kind of like fiduciary relationship with the accountant, and where they go, the accountant's not a threat to me, right? Like the accountant doesn't have anything to sell me. And so my accountant, surely he knows everything about investments. He's a money's guy, right? Like that's kind of what
you would
people
think,
right? Like, hey, he probably knows everything. And so some of my best clients have come from accountants that had tax problems and really needed some investment solutions and longer term tax strategy and planning to solve those. And some of the software accountants have been really good to know that they didn't have that skill set and they needed a partner to do that.
Yeah.
So that being said, I think that is a really interesting and smart way to approach it. I personally enjoy tax planning and tax questions.
Which is rare. I mean, that's not easy to do taxes. I mean, to speak that language.
Yeah.
Yeah. I would say, it's nice to be a go-between, usually with a client and a CPA, so you can talk the same language.
That's the way that I often explain it, right? So I don't have any interest in filing taxes, right? Like I don't want to do taxes.
Yeah.
I am very grateful for our accountant, partners out there that do that, because then that means I don't have to, right? And that's not something that I want to do. So, but from a planning standpoint, right? So doing some of the strategy work around investment decisions and what's going to be tax efficient and stuff like that, looking at it through that lens. really complements what a good accountant is doing for, clients on their taxes now. And a lot of times, I don't want to say, oh, we're the unsung heroes, right? But we're solving some of those tax problems before they come tax problems.
Yeah.
And people don't always see that. It's hard to quantify that value.
Yeah.
But all you have to do is sit with a number of clients that have tax problems. They go, oh man, if someone would have done something different 10 years ago and we were sitting here,
we
would
wouldn't
be
be
way better.
No, I think we end up being like a CPA's best friend.
Yeah.
And sometimes it takes a while to get them on board.
Mm-hmm.
I remember specifically working with a client who their only income was Social Security and IRA distributions, and they hadn't yet started their RMDs yet.
Yeah.
And we did some tax planning, and I think you use Holistaplan for kind of some of the tax planning software, or no? Or are you looking into it still?
No.
Anyway, it doesn't matter what software you use.
There's softwares out there.
Yeah, I just bought it. I decided to buy it, but anyway, we could do a conversion and not pay any tax up to like $20,000.
Mm-hmm.
And so the first thing I did was reach out to the CPA and say, hey, look, here, I did a tax projection for this client. This is what it looks like. And he was like, oh, no, don't do that. Don't do that. It doesn't make any sense. So it's like, what? Are you kidding me? He's like, and this was an older school CPA.
Yeah.
He's like, send me the tax projection. I'm like, what's your email? He's like, oh, you gotta mail it to me. I'm like, I got to mail you the tax projection? I'm like, yeah, just mail it to me. I mailed it to him and he still didn't like it. He's like, oh, it doesn't make sense to do that. Anyway, I convinced the client otherwise. And then afterwards, the CPA got on board and it's like, oh, you could have done 2,000 more. And it's like, that's fine. I got him on board, right? And so sometimes they can be their own worst enemy because a lot of them can be very conservative, but they can end up really helping you do what's best for the client. And sometimes I would say a lot of times, sorry, I'm talking so much. A lot of times I feel like a CPA, they're so busy because they got so many returns they have to do. They're constantly just looking at, here's my packet of stuff. And so they're like driving a car and they're looking in the rearview mirror. Mm-hmm. They're not looking at the front and saying, okay, what are some actually opportunities that we could do now and potentially adjust our taxes in the future, right? Mm-hmm. And so luckily I'm sure you got some good relationship with some CPAs. I have some great relationship with CPAs that are definitely more forward thinking. Yeah. And so they're all usually coming to me of, hey, what are some things that we could do? Or, and I'm vice versa, right? So a lot of conversation with CPAs.
Mm-hmm. CPAs certainly can be your best friend in this industry. Yeah, I mean, I have so many thoughts around taxes. I don't even know where to start. I know there's so many things when you start talking about Roth conversions and how much to do and when, because you want to maximize a tax bracket, but you don't want to mess with someone's, if they're kind of that retirement age, you don't want to mess with their Medicare premiums, right? Like there can be a lot there. There's different things you can do with life insurance contracts, obviously, which then, potentially leads into estate planning matters, right? And solving for estate tax bills with, high net worth clients. What do you think is a more common tax, kind of, I'm going to call it like a tax landmine, right? That somebody might run into from a planning standpoint that you go, well, if we would have planned for this, if you had known somebody, 5-10 years earlier and done the planning, that they wouldn't, have kind of hit that what I'm going to refer to as like a tax landmine, or it's just something that popped up and it's like, well, it would have been avoidable with some good planning, but now we're in a situation and now the accountant's trying to figure out what to do right now.
Right. I would say a lot, and there's a lot, right? What comes to mind right now is, I have some good clients that were good investors, put money in their IRAs, 401ks, but it was all pre-tax. Okay. And so when you look at they've done that for 5, 10, 15, 20 years. They've had some good compounding where they were invested appropriately or somewhat appropriately. And now they've got a good chunk of money and it's all going to be taxable to them. And so I want to say that can create some problems depending on their other incomes. And when they start pulling out money, it could potentially create a lot of more taxes than what they originally thought. And so it's figuring out having a good allocation, not just in your kind of tax deferred buckets, but also have tax-free buckets. Tax-free buckets I would consider our Roth IRA accounts, as well as life insurance is not a bad option where it makes sense.
Right.
And then you also have just your taxable, which that would include like real estate, just having a standard brokerage account.
Mm-hmm.
And so it's figuring out how to make sure that we have a good balance.
Yeah.
And it's not so one-sided to where everything is going to be taxable to you.
Yeah.
And so, I mean, I come across it way too much where they just have a house, they have Social Security, and then they have an IRA that's all going to be taxable to them. And sometimes that can be okay because they're in a small enough tax bracket, but it just kind of, you don't have near the flexibility.
Right. If you come into retirement and your net worth looks like, your home, your cars, everything's paid off, you're debt free, and you have $1 million in a tax deferred IRA, and you're going to be getting Social Security, right? Like that's kind of your plan is the majority, or if not all of your plan is to have income provided by your IRA distributions, right? What's the number? For me, I guess maybe
what do you come across?
Well, in that situation, right, that we just talked about, like one of the concerns that I see is it's not too bad in like an annual distribution scenario, right? Like, hey, I'm taking out kind of a set amount or a percentage amount every year, and it's kind of smooth and everything. But the problem becomes when, you get the call as an advisor, right? And they're like, my kid's going through a divorce, and I need to help them buy out the equity in their home so they can keep the home and with the kids.
I need some cash.
So I need like $200,000, right? Or I need $300,000 out. And you're like, that is a big distribution that will put you right away, boom, right up into the higher tax brackets, right? Yeah. As a retired person, like you don't have a lot available to you for oftentimes, reducing that tax liability, right? So you're just kind of eating it. And it can be a hefty tax bill in that sense. So getting even just some money outside of that. But I think, one of the unique things you talked about is the taxable brokerage account. And I see this a lot with people is, so one of the things that I see, right? I work with a lot of my clients are high income earning entrepreneurs, and they will make a really solid income, and they know they're staring down the barrel of they have this really big problem on their hands where they made too much money. That's what they always feel like.
Yeah.
I'm gonna have to pay all these taxes. And I'm like, from a tax planning standpoint, sometimes you are, right? You will have to pay taxes, and the goal in life is to not pay no taxes. The goal in life is to not pay any taxes you don't need to pay, right? There's kind of a difference, and people forget that. So, I always tend to just as a piece of general education, I say, don't spend $1 to save 40 cents. Yeah. Right. When people are looking to just spend money just to have a write-off in their business or whatever.
I should go buy another vehicle.
Yeah. The 179 deductions, right? Accountants always have an interesting take on that, and good accountants typically like to stay away from that. It is what I've observed personally. Right. But, sometimes I just talk to people like, hey, if you're not qualified to do a Roth contribution, right? Because you're making too much money, right? And you did the SEP contribution, or you did the simple plan, or you did you know what I mean? Like you did what you could, but you still have all this money. Like sometimes a good tax planning strategy is to put it in a tax efficient vehicle still, or a tax efficient investment just through some kind of brokerage account that you can let it grow and then control when you pay taxes in the future on it, and have capital gains treatment on it instead of short term, which gets taxed at ordinary rates, right? Yeah. So just a different tax treatment. It puts it in a different tax bucket, right? You want to take something and put it in something that you're going to eventually maybe get qualified dividends on, for example, right? Yeah. Is going to be a different tax treatment. And so, you're not lowering the tax bill today, right? But when you run that scenario, like, well, what if we're efficient? It's like all of a sudden, sometimes you can see like, whoa, we're lowering a tax bill by sometimes hundreds of thousands of dollars over the course of somebody's life, right? By changing the strategy or the place in which you're investing, right?
Right. And I would say the problem is it's hard to like quantify that to a client. Yeah. Right. I mean, you could probably do some fancy spreadsheet, or maybe there's some systems out there, but they're really it's hard to just look at it from right now. It's like, what? I'm paying more tax? It's like, well, this is going to save you in the long run.
Yeah.
And going back to like a taxable account you were talking about, I've actually started doing, just in my own kind of planning philosophy, is I'd rather, I mean, if they have a company sponsor plan, get the match, do those things, because the more you can automate your situation, the better. But instead of, or what I've been doing is open up a taxable account from the get-go and have that kind of be like your working capital account where it's actually earning for you. Now we figure out what we should invest in, whether that's more conservative, more aggressive, but you can do a lot of things with it. You know, you can actually, if you've got other earned income, you could take that taxable account and go fund your Roth IRAs with it.
Yeah.
You could go fund your life insurance. You could go buy some real estate with it. You can do, if you got enough money, like an SBLOC, a security backed line of credit, kind of like a home equity line on that account. And so it gives a lot more flexibility to move monies in comparison to locking it away in those retirement accounts, which is not a bad thing. And some people need that. Kind of can depend on your behavior and everything.
I love my Roth IRA. That's like,
right. Yeah, no, I'm very glad that I have the Roth IRA that I have. But I'm sure you come across this a lot, where math is math, but sometimes you need to include the behavior, the psychological side of things in financial advising.
Yeah.
And I'm sure we could talk a lot about that, where, man, I was talking to a client the other day of, yes, here's the math when it comes to, and let's just use a simple one of, you know, hey, I want to pay down my house. I hate debt. I don't care.
Yeah.
But when you're talking about debt, where luckily for those people maybe who locked in 3%, right?
Yeah.
Which it's like, please don't mess with that one. But if they've locked that in, but they want to reduce that, when they could go and get a holding money market and get 5%, you're losing money when it comes to math. At the same time, some people just cannot deal with having any debt. And so as long as you can explain to a client and say, look, here's the pros, here's the cons, here's what we're missing out on. And as long as you're okay with that, fine. I mean, would I do that? No, but that's okay. You got to be able to sleep at night.
That's the key, right? You gotta sleep at night.
Yeah.
I guess I'm probably allowed to say this. Right.
Yeah. Well, I'm thinking there's probably some things
compliance
I
is
say.
Well, compliance is absolutely paying attention now, right? But it's my dad. And he tells this story all the time to people.
Yeah.
About paying a mortgage off early, in his own personal experience, and that was that he, felt inclined to pay the mortgage off early, and people thought at the time, well, why are you paying it off? You have a low interest rate and all that stuff. Well, that was in at the time is the fall of 1998. Okay. And so although he had invested into the, using the tailwinds of kind of the .com bubble as it was growing, right? He didn't get out at the very top, right? Obviously 98 wasn't the very top, but it enabled him to start this practice and this firm in 2000 and 2001.
Yeah.
So he didn't have a mortgage. He didn't have that risk hanging out there, and he was able to sleep at night and not worry that us as his kids, weren't going to have a place to stay, and, he was going to have to get out and, put his integrity on the line or something like that. He was never in that position because he didn't have the debt. So it's like, there's a lot more to managing debt and managing money and planning than just, hey, this makes the most mathematical sense, right?
Yeah, exactly.
One of the books that I love is The Psychology of Money by Morgan Housel. I don't know if you've ever read that.
I don't think I have. I think I started it. I probably should, though.
Oh, it's such a great book.
Oh, yeah.
All the chapters read kind of independently of each other. So it's pretty easy to read, right? Like it isn't like build and build and build on each other.
Gotcha.
You can pick it up and kind of read whatever chapter. But in one of the chapters, it talks about reasonable versus rational, right? And so it uses a mathematical study to show, and I may get this wrong, right? But I told you guys the book, so go check it and read the chapter for yourself here. But basically, it's saying if somebody starts at 18 and goes to retirement, and they use 2-to-1 leverage on their investment account at all times, they come out ahead. They will be wiped out, right? Like multiple times. They will go from all to zero because of the leverage. And then they just, but in the scenario, they just, start back the next day and just, keep having money coming in from their job or whatever. And they keep investing the same way, right? Using all this leverage. And in every iteration that they were kind of playing with this under the parameters they gave in the book, they come out ahead of somebody that just buys with, no leverage and just, builds their investment account. And the problem is, it was like, yes, it's rational. You can rationalize it with the math, but how many people do you know that can go from, all of it to none of it, right? Overnight. And they just start back, right? No hesitation. Just, just keep on. It would just not happen, right? Like, it's hard enough for people to stay in the equities markets with the volatility that's at the baseline of no leverage, right? So, like, to go back and say, like, well, it would make more mathematical sense to use, all this leverage, and if you lose all your money, it'll be fine. We can just keep going, right? Like, that wouldn't be prudent, and it's the reason it's not prudent is because people can't stick through. But it goes to a deeper level, right? Like, what can somebody handle? And one of the things that I think a lot of financial professionals sometimes miss is that if you're not helping somebody get to their goal at the end of the day, right, then you haven't helped them at all, right?
Right.
Like,
I think we easily forget money is just like a tool, right? It's a tool to do what? What do we want this to accomplish? A lot of it can be retirement. Well, then you have a conversation. What is retirement? Yeah. I mean, retirement has definitely evolved, probably just in our time period of being advisors, where you kind of have, hey, as soon as I hit 65, I'm turning my keys, I'm done, I'm going to go golfing, I'm just going to not work. You talk to people retirement kind of our age, they're like, they want flexibility to retire. Yeah. And retirement can mean, I want enough cash producing assets, whatever that looks like, to do the working for me. So then I could go do whatever I want. Yeah. And so I mean, it's really, I would say nowadays it's more finding balance now and at the same time have flexibility later. Yeah. And whatever that looks like, it all varies. I mean, it doesn't have to be cookie cutter and be the same for everybody. It can be a wide variety of different things. Yeah. I saw that pretty quick as I started to sit with clients. And so one of the questions that I always like to ask people now that I found to be really thought-provoking for them is, what can you do in retirement that you can't do today? That's a good question. And you can get some really insightful answers. Well, I could travel more. Okay, well, do you really want to retire or do you want to travel more, right? Like, what's... Yeah. Is what's holding you up right now? Yeah, maybe we're looking at this all wrong. Maybe what you're really getting after is maybe you should cut back a little bit now at work, and we should budget and pull back some of these distributions and just start going on that annual trip with your family now. Yeah. And, because if you don't care the difference between working until you're 63 or 65, but you could do the things you want to do when you're 65 and you could just start doing them now with your family, then why don't we do that? Yeah. That could be more impactful. And people just think I'd never thought about that. I thought I just had to grind away and save. Yeah, just put your head down and punch out, and just. Yeah, and that, oh man, I think our generation's getting a little bit better of seeing I'm not being mean, like seeing the bigger picture of what they want. Really more of understanding their values, and that's what you should put your money into. And whatever those values are, everyone's different, but that's fine. Yeah. I think one of the things that the problem that outlook on it is solving for our generation that they're oftentimes, I think, not talking about enough or having a good enough understanding of, that they're kind of overlooking, but they're solving a problem inadvertently, is the longevity risk. Yeah. Right. With the advances in medical technology and, how long are you going to live? Right. I listened to somebody recently that said, if you're under the age of, I think he said 40 years old, the statistical likelihood of you living to 100 is something like 85% now, he believes. There's some study to show that, right? Insane. And that's crazy. That's crazy. That's a lot of longevity, right? When you start talking about drawing down long retirement. And you want to retire at 60 and you're only 60% of the way there. Have a big nest egg. And but when somebody starts saying, "Hey, I'm cool to keep working," right? I want to have, I want to leave my high stress career and go to something that I enjoy, right? Or become a consultant, or
I want to start a business, that I'm passionate about,
Right.
or
I'm going to go work at the golf course.
oh man, I see that all the time
Right?
in St. George.
Yeah, it happens a lot.
All the time. And or I used to work at a gun store like way back in the day before I joined the Army. Right. And, there's a ton of guys that were retired that were just, they just liked working the gun counter, right?
They
Like
enjoy
they get to hold
doing
guns
it.
all day and talk about guns all day. And that was for them. That was the pinnacle. That was great. They love being there. They love doing that. And, but what it does is that really solves for the longevity risk. And
oh, for
like
sure.
it makes the planning side of it way easier.
Yeah.
And there's nothing that terrifies me more than when I start seeing, like when I get somebody's current financial plan and you see that the life expectancy on the plan was like 80.
Oh yeah.
And I'm like, oh my gosh,
dude,
I'm like, man, you're already 72.
Right. And I have some clients that cause now, the software that I use, I always just default to 100.
Yeah.
And it's like, I just need to see it to 100. And it's funny because I get some clients that are older be like, I'm not living that long. I'm going to live to that.
What happens
My
if
mom
you
lived to
do?
like 80, 85, just put it at that. It's like, yeah, but what if you do?
Yeah.
What, right? There's so many variables. I mean, and as an advisor, your fiduciary, you have to kind of make sure that they see from all sides. So, to ask, well, what if you do?
Yeah. Yeah. We have a kind of a proprietary, planning tool where we can put in some basic assumptions, and we can kind of put in what they're doing now, and then we can put in some assumptive recommendations, and it kind of blends out the scenarios, and then you can kind of adjust the recommendations to make it work, and you can kind of show someone like, here's what you're doing now, and here's kind of what you need to do to make it happen. But it also spits out. It's kind of funny. Like, I don't know, whoever coded it had kind of a sense of humor, because it says, like, there's a section when you do that report, and it says like your goals are not going to be met unless one of the following conditions are met, right? And it'll say, as an example, like you have to increase rate of return from 5 to 6%, right?
Sure.
Or you have to decrease your withdrawal rate from such to such annually, right? Or you have to work a couple of years longer. And then the last one's like, you have to live till 87 instead of 100, right? You have to die sooner.
You have to die sooner, and then this plan works great.
I'm like, that's my college professor, Kaplan Sanders, over at I don't know. I still always call it Dixie State, but Utah Tech over here. Yeah. He was a neat guy to have for professor, and has a really interesting sense of humor. Yeah. That always made class just so enjoyable for me. Like, truthfully, I'm not even saying that sarcastically. He really is kind of a funny guy. Yeah. But he would always tell people like, people never die. They just experience the end of their financial plan.
Oh, yeah. Well, and it's interesting too, when I first started in the industry, I remember doing my big capstone class at UVU, and it was a big group project and everything. And it was basically giving like this 50 plus pages, I can't remember how long it was, of a financial plan to someone. Mm-hmm. You were given a scenario, a client, and you kind of had to give them this big plan. And I'm like, and you get into the real world. Yeah. And it's like, if one thing happens, it throws that whole binder out the window. I mean, because people are constantly going through some type of transition, and usually there's a financial component, right? You have a kid, you lose a job, you retire. And so it constantly, to me, it's hard for me to see having a 50-page book, right?
Even if you revisited that plan annually, right? You're like, I redo my financial plan every 3 years or something, right?
Right.
I go pay someone, X dollar amounts to build a new financial plan every 3 years, bring it back in alignment. Like, you're kind of introducing sequence of returns risk every time almost.
Yeah.
Right?
Yeah,
like,
would be.
You know what I mean?
Yeah.
Instead of kind of the bearing checks on the ship, right? To kind of keep it on course.
Yeah.
You're just like introducing, we had this average, return rate, but, a year after we started this plan, you had a 30% drawdown or something, right? Like, it completely changes what is going to happen, right? And so the problem with that plan then becomes everything after that point is all of a sudden redundant, because that sequence of return risk in a Monte Carlo simulation throws you way down off the, it just skews it so much. And so I've never been one to do the full right? Like the full,
Yeah.
what I call like quote unquote the full plan, right? And I had somebody ask me about that a couple of years ago. They said like, yeah, I just, do you do like a financial plan? I can just pay you, they were wanting to offer me like $1,500 to just do a financial plan. They'd kind of, lay it all out for me. They want me to do a plan, hand them, I always joke, hand them a ream of paper, like,
gosh.
And I just said like, no, I won't do that. And it's because I just don't believe it's valuable enough. Right.
Yeah.
I truthfully don't believe that that's worth what he wanted to pay me for. And what I would have rather done, if somebody wants that experience is, why don't I figure out what we need to do now, what your next best decisions are that you're facing that are actionable, right?
Yeah.
Let's get you on the right path. And, why don't you give me a couple $100 per year to keep the ship on path, right?
Yeah.
Let's revisit. Okay. Is there something new we need to do? Is there something we need to do different? Right. And just do that annual review, right? It makes way more sense to me, right? Like a captain, doing a financial plan and then saying, well, I have a plan. Right. Oh, have you ever had that? Like where somebody says, oh, I got a financial plan done like 15 years ago. We're good. And you're like, oh my gosh. But I've heard people say it like that.
Really?
And I'm like, holy smokes. Because like, I think about it like this, like can you imagine if you're like going to take off you're going to fly out of England, right? And, you're sitting on the airplane and, you're like getting all cozy and the captain comes on and, you look up front and he's not in the cockpit. He's just standing up front where the stewardess, and he's like, all right, I set our bearings to this. So plane's going to take off. It's going to just fly you straight there.
Yeah, I'm getting off that plane.
You should be good. And then he like waves and walks off, right? He's like, I pointed it in the right direction,
Yeah.
And it's like, whoa.
You're telling me there's not going to be some turbulence sometime,
Nothing,
or
right? Or like a ship leaving, whatever. I mean, a ship going across the ocean, an airplane flying, XYZ thing, right? It's like, it's a principle of you can aim it at New York, right, from England. But if you're just, like 1 degree off, you can, I don't know, whatever it is, land yourself in Georgia. Right?
Yeah.
And it's like, if you're hoping your retirement is New York and you land in Georgia, that's not,
for sure.
It's not what you were hoping for.
For sure.
But if you stay, if the captain kind of stays with the ship there and you just make those small adjustments, right?
Yeah.
Just a little bit as you go here and there, keep you on course. You get to where you're going.
Right. No,
and I think that's the value of a good planner and good planning conversations, right?
Right. So, no, it's all about adding value. I mean, and to go back with the plan, it's not necessarily the plan, it's the planning that's going on with it.
Yeah.
And I mean, and we've talked about this previously where like if I can't put like an action plan like on one page, I'm not going to do it, or we're going to simplify it. Because if you're going to get a whole bunch of pages, it's just not gonna make sense to you. You're not gonna look at it. Something's gonna change in your situation. And so it's almost, it's the planning that goes into it of, okay, here's a few things that we need to focus on right now. Whatever that ends up being, let's make those adjustments, whether that's with your investments, your real estate insurance, get some basics down. And then we're kind of setting ourselves up for our future. Because I don't know. I mean, it's interesting to see clients where they really have, and it's all walks of life, but they're coming to you because they want advice. Yeah. I mean, that they sought you out or they have some type of question, whatever that is. And a lot of times, you need to answer that question, but it's funny whatever that question ends up being, we always have to, and I'm sure you deal with this a lot as well. To answer that question, it really depends. Depends on what? Depends on everything else you got going on. What is the ultimate? What are we trying to accomplish? Yeah, like people ask me all the time, hey, if you just had, like just asking for a friend here, like sure,
right. Hey, if you had, $300,000 in the bank right now, where should somebody put that? And I'm like, I don't know. And they're like, you don't know? How do you
not know? You're a financial advisor.
Yeah.
You do. Yeah.
I'm like, well, it depends. And they're like, well, what does it depend on? I'm like, who is this person? Like, how old are they? What does the rest of their balance sheet look like? Yeah. Do they have debt? If so, what kind? What's the rate on it?
What do they want this money to do for them?
Yeah. Like, does it need to grow? Do we need to preserve it? What's the intent for the money? Like, what's the time horizon? Yeah. Right. Like all of these parameters. And it's like,
and they're like, and it's funny because some people are like, I just want you to answer my question. It's like I can't.
Give me context, right? Context, as compliance always tells me, context matters, right? Yeah. So, if you have $400,000 in the bank, but you have a brokerage account of $4 billion, right? What you can do with that $400, or that 400 grand, looks entirely different than if $400,000 is all you have.
Yeah.
Right. So it's just, it varies so widely. And, being independent guys like ourselves, I always tell people, like, we just have the full toolbox, right? Like we're not painted into a corner by a bigger firm that says, Aaron, you got a quota to sell this many, policies or accounts this week or this or that. Hey, Aaron, we're doing more of this, sell more of this and call your database and, do that. It's like, we're kind of like taking your car into the mechanic shop and being like, hey, there's a weird tick in the engine, right? Or there's something's going on wrong, or I want to do an upgrade because I need more performance or whatever, right? Whatever. You go in and tell them, like, what your goal is. My goal is to fix a problem or make something better, whatever.
Yeah.
And then the mechanic goes to his toolbox and gets out whatever tools he needs for that job, right? And what I always tell people is, like, it would terrify me if I went into my mechanic and he had a screwdriver and a hammer and that was it. And he's like, yeah, we can fix this. I'm like, ooh, that does not seem like you have all the tools to really adequately do the job, right?
Yeah.
Especially with the old saying, right? To the guy with a hammer, everything looks like a nail.
Yeah.
No,
and that's,
And so without having, like the one size fits all advice, being, independent advisors, that's kind of what, man, you got to give us more context.
Yeah,
we want to, it's like, we're not trying to sell you something.
Right.
We desperately want to answer your question, right?
Yeah, we get, I'm sure just like you, I get super excited and it's like, but yeah, give me some context here.
Yeah.
And it's like, and a lot of it might not be the setting for it. And it's interesting because and I would say most people that I deal with, most clients, is they can become like an open book. Mm-hmm. And especially when you have like a husband and wife where it's crazy to me that they have really not had these conversations about money. They've really kind of siloed or whatever they decided to do, but you can be a really good resource to them of just, let's actually open up and have conversations about money.
Yeah. Do you ever have the clients or people that show up to do some planning, right? Or like a first client meeting or something, they say, yeah, my spouse doesn't really like to do any of this, so I'm just here. We'll just do it, me and you.
That. And I get that, yes.
My thought is always, please, 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 please bring back your spouse, Yeah. Like, what can I do? Like, what, I always want to tell people, like, give me the briefing. Like, is there things that we should avoid talking about that, like, or just whatever, like kind of triggering for the spouse or, give me some context. Like, how can I handle the situation in a way that, makes them feel comfortable? But I think it's so beneficial for people to, in a marriage or domestic relationship or whatever, to really get on the same page. Mm-hmm. Unless, they have like a prenup and there's like totally separate finances, right? And in which, hey, I'm not,
depending on the
judging.
Depending on the circumstances,
so
it can depend.
Right.
But
imagine that, right? It depends, right? It
depends.
Always depends.
Right.
But for your, sort of typical, right, like married couple, you kind of, it's so valuable to get on the same page with finances.
Yeah. Well, and cause you might see things differently. Like there might be a client, one of the spouses is very much risk averse. Mm-hmm. I'm sure you get this a lot. The other one is just puts it all on black.
Yeah.
And it's like, and then to have a conversation with it and everything. And so, I think I deal with that a lot where there's usually one person that, in a relationship that's like kind of initiating everything. Yeah. And then there's sometimes the other person who is like, oh, just do whatever. And it's like, you got to have be both involved.
Well, and
as much as you can.
I think, and I don't know that I'm going to agree with you, like be involved as much as you can, but I typically understand that one of the spouses is not going to care to talk about the numbers, right? They're not going to care to sit there and have me say, are you okay with this kind of return given this level of risk? And
right, because they're going to get bored.
Are you okay with this type of outcome? Have you thought about your insurance? Have you, blah, blah, blah. And they don't want to do that. They don't want to think about that. But I think about it like if I was with my wife and, I went and sat down with a financial planner and they're like, so what are your goals? And I'm like, well, I want to retire early. I want to shoot a lot of guns. I want to spend a lot of time golfing. I want to be right. Like,
Right.
I want to hang out with my friends. I want to buy a bass boat, and the guy would be like, yeah, great. We can build a plan around that. And then I take it home and I'm like, yeah, honey, we did financial planning. And she's like, so, oh my gosh. She's like, we have a financial plan. We're going to be able to go to Europe every year. Right.
Where's travel?
Yeah, exactly. It's like, so you got to represent both kind of parties and like, man, are the goals there? Right. For me, that's kind of the big conversation is like, what is the purpose of any of this? Yeah. And I always try to drive it. What's the goal? One of the things that I had a mentor out of the real estate business, he always asks is like, what's the goal of the goal? Yeah. Right. So I always ask people in the sense of what's important to you, what matters most to you. Right.
Yeah.
And then they always say, not always, but the common answers, right? God, family. I really want to spend, time with my kids. Like those are the things that matter to me, or I really need to be on the lake fishing because that's where I find my peace, or I have health conditions and I feel bad every day and I know I'm getting worse. I got to get out of this job I have, right? You're like, okay, well, like that's the actual goal, right? Like having $1 million in your retirement account isn't the goal, right? It's kind of like the means to the end. So that's what's important to you. And that's what we're trying to drive at is helping you accomplish or be fulfilled through the things that are important to you, right? That's the whole point of financial planning.
I like that word.
And then we're taking it then we're just breaking it down. Okay. So what tangible goals do we have that are going to enable us to do those things, right?
Right.
So, then we're kind of back engineering. Okay, we need to, your health is, getting tough, right? Okay, we need to retire in the next 3 years, right?
Yeah.
Okay, well, in order to retire, what is that? We need this kind of income to, replace your income from work, right? We need to be able to produce that. We need to do this, or these things, right?
Yeah.
And then somebody says, well, yeah, I mean, I spent a lot of time on the lake, but I also want a new boat. Okay, great. We can put that down. Like that's, you know what I mean? Like what's important is being out on the lake. Yeah. And then like, maybe a goal is to like have a new boat to go with it. Right. But, but now we can tag a number to that and say, how do we fund it? Right. Yeah. And then you're just back engineering it a step further and saying, where do we need to invest the money to, get
make this possible.
Our expected or hopeful returns to, meet that goal over time.
Yeah.
Where, what financial products do we need to access to solve for different types of risk that you're facing in this plan so that you can accomplish these goals.
Yeah.
Or, work towards them, right? Hopefully accomplish, right? Obviously we're not in the business of guaranteeing, but
we never guarantee.
Never guarantee.
Never guarantee.
But that's that's a reverse engineering, right? And that's why I asked the question, like, well, what, going back to earlier, what can you do in retirement that you can't do now?
Right.
Right. It's like, I'm just trying to drive it. Like what is really most important to you? Because to sit here and say, I want to retire early and have a lot of money. That doesn't give me enough to work on. And even if I derive from that, okay, we should take high risk and shoot for high return because that's what they want. And that's what will get them to retiring early. Again, at the risk in that scenario, right? Like the more risk you take, you might work a lot longer,
right? Right.
If you ever retire at all. But what's like, is that really adding the value that the client needs? And then, by the way, if it's not tied to anything or you don't really understand behaviorally, are they just going to stop and call it quits as soon as there's that volatility? Yeah. Right. And they experience that first time they open the statement and they've lost, money or whatever. Right.
Right. No, it's tough. I like how the word fulfillment that you used. I would say, yes, that is one of the goals that I have with working with like any clients is you really do want to kind of drill down. You're asking tough questions. I mean, you're kind of like, I use the example of being like a doctor. I mean, we need to kind of be very holistic in everything that we're looking at to see what drives them. I mean, I do a lot of, and I've been trying to focus a little bit more of just even having clients do like value tests of like, what are your real values? Just today, I mean, a client needed help with a budget. And budgets are hard. They're never fun. They can be really rewarding if you actually do them or stay consistent with them anyway. But I think having values, and whatever they are, it kind of gives you permission to be like, you know what? It's okay to spend this money on my family, on my whatever it is, whatever those values are, because that is the fulfillment. I mean, and so it's almost, I feel like a lot of times, not intentionally, I'm giving permission to clients like, it's okay to spend this money. Because it's what you want. You worked so hard on you work so hard, you have a big lump sum. Another client who, hey, I really want to fix my kitchen. But the only money I have is out of my IRA.
Yeah.
And so it's like, well, I'm sure we can make that work. And it's like, well, the taxes and everything, it's like, we can figure this out, and we created a plan to be like, hey, let's do this and this and this. And she got the kitchen that she always wanted. And it worked out, and it was in the plan. And so it's really rewarding on my side of things. And I'm sure it's really rewarding with you when those goals, that fulfillment happens. And you were, I don't know, I mean, you were a part of it.
Right. It is really fun to see people have those experiences where they didn't think they could do something, and you get to say, I'm kind of like, yeah, you're right. People always look at us as like we're like the kind of the steady hand at the wheel, right? And we're like, hey, they're always expecting us to say, no, you got to save more,
right?
You got to save more. Don't spend anything. Don't take any money out, right?
Oh
like
gosh,
live,
yeah.
And I'm like, man, there's 2 commas in your account. You probably can. I'm like,
right.
Where do you, it's like, hey, and I don't know, I've done, every client's different, right? But with some clients, I take the, what's called like the bucket approach, right? Or I'll refer to it as like capital stack. And so, rather than doing, more like traditional asset allocation, like, oh, you have a blended portfolio of, of XYZ things. Like, hey, you have a specific asset or asset type in the account that specifically would be low volatility, easy to liquidate, and would be able to cover your expenses for a certain number of years, right? So that way, if you experience volatility in the rest of your account, right, we don't have to draw down on that while the market's down, right? You don't have to have that like fear and concern. You have kind of, whatever they determine, right? 3 to 7 years worth of income sitting on the side. Right? Like ready to go.
Yeah.
And it's been really nice having high interest rates certainly help that style of planning.
Right.
But somebody calls up and says, yeah, man, the market's down, but I want a kitchen done.
Yeah.
You go, well, hey, we kind of have this built into the plan.
This.
We've built in, and they go, oh, really? It's like, yeah, like, where do you want the money sent? It's just like, it's that easy.
Yeah.
Oh my gosh. Like, yeah. Hey, yes, there's going to be some tax implications if it's coming out of a traditional IRA.
Right.
Yes, you may pay. Yes, it may push you into a higher bracket. But what we can also look at is we can look at everything and say, if before your chance or probability of success on a Monte Carlo simulation was 100%, and you take this money and you do your kitchen, and your probability of success is still 100%, or it's, 99%. Like, are you okay with 99%?
Yeah.
Well, yeah, I'd rather 99% in a new kitchen sounds great to me, right? Like, great. Where do you have the money sent? I'm not here to hoard your money for you, right?
Right.
Like, I'm here to help you navigate the decisions. And if it's not going to, totally blow up your plan, right? I mean, if somebody calls up and says, I've really just, Aaron, I've always just wanted to go gambling in Vegas. Could you send me my whole IRA? You're like, well, that's good. Let's
talk about that.
Right. Let's talk about that. But
right.
Most people are wanting to do some pretty prudent things still,
Yeah. No. And I like the bucket approach type situation. I think it's simple to understand. I would say that I do it for my own stuff. It's like, do I need money? And a lot of the investing I do is depending on the cash flow that you need.
Yeah.
If you don't need cash flow, so whatever that equates to be, don't have it in such volatile assets so you can easily pull from it, just like with your example. For me, I can say, well, I don't really need that stuff now. I don't even need it necessarily soon. I need it I need it later. So I have my growth bucket, right?
Yeah.
So I have everything in my growth bucket where, yes, it's going to go up and down, and I understand that and realize that, but I'm okay with that because I don't need to pull from those funds. Now you always, and I mean, going back to basics, right? Where, hey, you probably need to have some type of cash reserve.
Mm-hmm.
And so as long as you have something like that, then you'll be fine. But yeah, and everyone's different. It's interesting kind of because this bucket approach that I do, it's not like one size fits all. I mean, some people really want to have more in that conservative bucket compared to the growth bucket. Even my retirees. It's interesting too that, especially dealing with longevity, what you brought or talked about previously or just a little bit ago, is I think a lot of retirees don't realize that, hey, you could potentially live a long time. We probably need to have some type of vehicle, whatever that is, in our more growth portfolio, whatever that looks like, because, hey, inflation is still ticking at 3, 4, whatever %.
Yeah.
That dollar is going to lose value over 5, 10, 15, 25 years. And so we do need to allocate into some type of growth component.
Yeah. Yeah.
Because I definitely see a lot of retirees where, I mean, they think, hey, I'm retired now. I'm putting everything in cash, bonds, and something like that. And it's like, well, let's relook at that.
Some of them might have learned that lesson on that traditional asset allocation last year.
Oh, yeah. Yeah.
I have a lot of new clients, I'll say, that learned that lesson. More difficult than others, right?
Yeah.
I recently heard somebody, there is a I'll tell you what ticker it is after we're done filming. But I heard, I was at a conference recently, and I heard one of the presenters refer to this specific ticker because it was supposed to be a safe, it was kind of used, generally speaking, as a safe allocation in people's accounts to get them a smooth exposure that was supposed to have a negative correlation to stocks.
Gotcha.
And you may know which one I'm talking about. And anyways, this fund has lost almost 50% of its value over the last 2 years. Right? Remember, it was supposed to be it was supposed to be.
Maybe that's a good thing. I don't know it. So
it was supposed to be. It was supposed to be, like, and I would see it, right, in people that got referred into me. It was on a lot of account statements, especially smaller accounts, right? But if you look at it, the flows into that fund has been like massive, like billions of dollars, and millions of dollars, right? And even though all this money's coming into the fund is still down, right? It's like the underlying assets are losing so much value. And so he said, like, this is a perfectly designed money incineration machine. Nothing has been more efficient at just incinerating money. And but that's where I take some issue personally with like the traditional buy and hold, right? Like what is a safe and secure asset really?
I don't think there is one.
And sometimes I think on that traditional buy and hold where you look at, okay, what's supposed to be, two negatively correlated asset classes, and
right,
we'll just balance it out that way. It's like I had another person in the industry tell me one time, they said the only thing that goes up in bear markets is correlations.
Oh yeah.
Sure. And it was true, right? So like last year, stocks were selling off, but so we're bonds as an asset class, right? And that was the traditional kind of hedge in portfolios, so to speak, right? And that was supposed to be your quote unquote, safe asset. And without having some additional skill on the portfolio management side to say, we're kind of reading the room here, and this allocation is probably not going to hold up, right, in this economic cycle. Yeah. You have to do one of two things, in my opinion. You either have to have your clients prepped to say, you're going to take a drawdown on this asset class, or we're currently taking a drawdown on this asset class, and it's quite significant, and it could take quite some time for you to recover. But we've built your portfolio in such a way that you still have access to XYZ things in your capital stack, right? Like there truly is. And you're hoping that it kind of plays that way, right? If that asset closed down, you have exposure somewhere else that is going to generating some returns that are up that you can liquidate those assets for the current income. Or you have to have an active style where you say we have a methodology to try to reallocate kind of out of this before it gets worse.
Right.
And one of the things that I see as a trend on the interwebs, with TikTok and all this stuff, right, is the boglehead approach, right, which is buy and hold, never sell, keep costs all low at all costs, and you can't beat and so oftentimes people quote Warren Buffett with you can't beat the market. And so as soon as I say active management, sometimes people are like, oh, you can't beat the market, Warren Buffett, and this thing with the hedge funds and, whatever, blah, blah, blah.
Yeah.
I'm like, yeah, but if you're in retirement, right, and that income stream is going to be turning off soon or has already turned off, right, from your career, you're not worried about the market. It doesn't matter really what the market does, right? Like your one-to-one correlation with the market is not truly what you want unless you're also okay with being 70 years old and taking that 50% drawdown, right? Right. And just being life-changing. What you're trying to do is, and this is generally speaking my goal, which there's no guarantee that I ever do this, right? But my philosophy is I talk people through retirement and the way that we're going to manage investments and that kind of thing is, is our return sufficient relative to the risk that we're taking? Yeah. That's it. It's that simple. It's not about what the market's doing. It's about what your account is doing, right?
It's people focus too much on the return when it's like, well, what is the goal? What are we trying to accomplish with this? Yeah. Which if we can lower the risk of and better give you a better chance to reach those goals, that's all what we're trying to accomplish. Yeah. Like, does it matter that, hey, yes, it sucks that we lost X%, but hey, because we planned for things like this, you are still on track to do this or to get this or retire. And so it's, I would say too, that there is a lot of, I'm sure you get this with market volatility, a lot of hand holding, a lot of getting people off the edge of just, you know what, this too shall pass. Do I know what the outcome's going to look like? No, but we will do this together.
Mm-hmm. Well, and that's the beauty, in my opinion, of, just in investing in general, right, is there's a way to get rid of some really crazy risks, like as an example, concentration risk, right? If you put all of your money in one company and that company goes bankrupt, your stock goes to zero. Right. But if you're fully diversified in your investments, you just kind of almost have the tailwinds of the U.S. economy at your back, which has an upward drift. It's just, if you kind of play the game long enough, right, you can work out pretty good. There's no guarantee, right? And the biggest reason why is because, if you were the guy just banking on the upward drift of the market and the U.S. economy, and you're going like, man, 2009 is going to be my year. I'm retiring, baby. Right? That was really, really painful lesson to learn. Yeah. That, although over time there's an upward drift, there can be in the interim some pretty painful periods. Right. And you have to be prepared to weather some of that volatility. Yeah. But so what it is, I think we're probably wrapping up on time. Ty's changing batteries out over there. So what's that? That camera just died. Camera died. So we're wrapping it up. Anyways, I appreciate you coming in, Aaron, taking your time. Some really good conversation. My hope is that what people get out of listening to this conversation is some thought-provoking questions, right? Yeah. Some things to start thinking about with their own planning, their own situation, and not to go, do drastic things and change. Don't go changing a bunch of things, drastically just because you listen to a podcast. Right. But start getting the wheels turning, and if people need some individualized advice, seek it from a qualified financial professional that's a fiduciary, acting as a fiduciary at all times in all places with anything they're doing with you. And if they're not licensed to, have to act in that manner, are they willing to put it in writing for you?
Right. Right.
So,
no, appreciate you having me on. I mean, this was fun. Hopefully I didn't say things too bad or say anything that compliance is going to come back at you, but
well, you're that's on you. You have your own firm. Aaron is not affiliated with myself, DuCharme Wealth Management or SCF Investment Advisors. But he can be found at Best Wealth Management here in St. George.
Best Wealth Advisory. Best Wealth Advisory. And you can go to my website, bestwealthadvisory.com.
Okay. Yeah, there you go. So, awesome. Well, appreciate you coming in.
Hey, appreciate it. Thanks, man.
Indices. References to securities indices such as, but not limited to, the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, MSCI, AEFE, and Russell 2000 reference an unmanaged group of securities considered to be representative of segments of the stock market or overall stock market. These indices may be market weighted, with the largest companies in the index representing a disproportional percentage of the index. Investors cannot directly invest in an index.